Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. Yesterday, the Reserve Bank Board left interest rates on hold, as was widely expected. But the commentary around the decision doesn't give a great deal of hope that we'll be seeing rate cuts anytime soon. The Reserve Bank has conceded inflation is stickier than expected, and there's a warning too about the impact of big spending government budgets, or at least any spending government budgets. Diana Mousina is AMP's Deputy Chief Economist. Diana, welcome back to Fear and Greed.
Thanks, Sean.
What do you make of yesterday? What did we learn from the Reserve Bank yesterday that we didn't already know?
I was a bit surprised to see the hawkish language in the post-meeting statement and also in the press conference. There were a lot of references to the upside revisions to consumption, which were in the March quarter GDP figures. Basically, what the ABS did was they revised up consumer spending based on more Australians travelling overseas. So they increased consumption, but increased imports, because if you travel overseas, it's counted as import. So no change to the growth data, but household consumption looks a bit stronger and household savings ratio looks a bit weaker. So the Reserve Bank, I think, has taken this as a sign that the consumer is actually in a better shape than where they thought it was. They did mention the higher inflation data as well. I mean, that wasn't surprising. The inflation data did surprise the upside in March and April, but I guess just the overall tone that they didn't even consider a rate cut this meeting, not that they should have, I think, but that they did discuss a rate hike. I don't think that they should have discussed a rate hike either. But clearly the Reserve Bank, I think, feels like if they need to raise interest rates again, then it wouldn't be that bad to the economy, or that the economy could withstand another rate rise from here.
It was almost like they were preparing people for the idea of a rate hike. Doesn't mean they're going to do it, of course, but there was such an emphasis on the upside risks yesterday, Diana.
Well, Michelle Bullock did say that the probability of a rate hike hasn't necessarily increased, but that they're just more vigilant to the risks. So I don't know, I guess take from that what you will. They're probably trying to play it safe, given the last few years of problematic communication. But I sort of agree that they're trying to warn markets and people that a rate hike definitely isn't on the agenda. And the key date when that might happen might be the August board meeting, because that's when the Reserve Bank gets the full set of that quarterly inflation data, which Michelle Bullock emphasised a lot. And they can really make their decision about whether inflation has continued to surprise to the upside.
So what are we looking for? We know that the 12 months to the end of April came in at 3.6%. This is the headline CPI. She made it clear that she likes the quarterly data more than the monthly data. So what are we looking at for the June quarter, which I think comes out at the very end of July? What sort of number are we hoping for?
Well, I think that the data might actually surprise to the downside for May and June. We often get this flow of inflation data that runs hot and cold, and you see that both in Australia and overseas. Early this year, global inflation data was running hot, above expectations. Now the last few prints in the US have been a bit weaker, and the Eurozone as well. So I think that that's what we're likely to see here, that the next two prints might actually surprise the downside. I think if inflation comes in at an annual rate of, say, 3.3, 3.4%, and also that the underlying number in quarterly terms comes out probably at 0.8% or below, that would keep the Reserve Bank quite comfortable with its current settings. If we get an underlying or trim mean print of 1%, similar to what we got last quarter, then I think that they'll hike again in August.
Stay with me, Diana. We'll be back in a minute. I'm speaking to AMP Deputy Chief Economist, Diana Mousina. So just explain why inflation isn't coming down. Michelle Bullock yesterday said that, obviously inflation has peaked. It's on the way. The trend is the friend, because it is certainly moving in the right direction. But she talked about services inflation. Just explain what she's talking about and how difficult that last mile is.
So I think the difficulty in Australia is that it's really in that underlying or trim mean inflation measure that's not coming down quick enough. In headline terms, inflation, as I said, was running at 3.6%. That's not too much higher compared to some of our global peers, but that underlying print's running at close to 4% in annual terms. And that's the one that takes out a lot of those volatilities. The areas that are mostly a concern are services areas like finance and insurance costs, education costs, healthcare and medical costs, rents, some utilities as well. So it's really around those areas that we have little, ability to influence through demand. A lot of them are government-driven, and also they often tend to lag what happens in the broader inflation landscape. So often things like insurance and finance costs will only increase after you've seen the inflationary increase in the goods sector. That's why services inflation normally tracks whatever happens in the goods sector. I think we will see a further slowing in most services prices, maybe apart from rents, but it's just taking a bit longer than the Reserve Bank would like.
What about, so we talk a lot about interest rates. The flip side is economic growth, and high interest rates slows economic growth. That's how it's supposed to work. Michelle Bullock spoke a lot in the press conference about the potential for a soft landing for the economy. I mean, is there a potential that we do go into recession if we keep rates high?
That sort of seems to be where the talk is now in the US. If you look at some indicators of the US consumer in the past few weeks, higher initial jobless claims, a higher unemployment rate, pretty poor retail spending, a drop in consumer confidence, the continuing inversion of the yield curve. I think a lot more people are becoming a bit more concerned about the US outlook and the risk that they do go into recession. The US consumer was really the key driver of that strength in US exceptionalism in the past 24 months. And that story is changing. And that's in a country where you get very little pass-through of interest rates to outstanding mortgage rates. I think if we see that weakness in the US come through, I think more people will become concerned about Australia too, even though, of course, we operate in our own domestic settings and we have our own drivers of the economy. But I guess it's a sign that high interest rates are working. So I think a recession is still a possibility. It's not our base case, but I'd say the risk of recession in Australia is probably about 20% in the next 12 months. I'd probably put it a bit higher in the US, maybe about 35 or 40% in the next 12 months in the US.
What about the role of governments and budgets? We had New South Wales yesterday. We had, obviously, the federal budget last month. What did Michelle Bullock say about the fiscal strategy and whether that's helping or hindering inflation?
Well, the Reserve Bank is pretty careful not to make too much commentary around the budgets. They obviously want to see apolitical. There was a slight comment that the state and federal budgets could increase inflation a bit more, or that they had more stimulus in them than what the Reserve Bank initially expected. There was definitely a tone that there was more spending than the RBA was hoping for, I suppose. And overall, if you look at the state and federal budgets, that's clearly what you see, especially with the release of New South Wales, Victoria and the South Australian budgets. They did have quite large estimates for budget deficits over the coming years, which look even a little bit worse. So there is this risk that the budget deficits and increased spending add to inflation. But when I tried to do the calculations about how much additional income consumers would get from some of those cost of living measures, it wasn't really enough once you take into account the increase in mortgage rates and how much consumers with mortgages are paying on housing, elevated inflation, and our forecast for a higher unemployment rate. I think those factors offset some of the kickbacks that consumers will get. Plus, if you believe the consumer sentiment survey, about 80% of consumers said that they're going to save the tax cut that starts from the 1st of July.
Okay, what's it all mean for interest rates then, Diana?
Well, we still think that the next move in interest rates will be down and that we will get a rate cut by the end of this year. And that really hinges on our assumption that we get a further increase to the unemployment rate. We think it's going to peak at about 4.5% by the end of this year, which is higher than the Reserve Bank's expectations. Also, we think that inflation is going to come down faster. And we've been of that view in this inflation cycle, that inflation is not proving to be persistently high. We think that it will continue to come down just like it has globally. And that will ultimately allow the Reserve Bank to cut rates. But it's going to be a pretty shallow cutting cycle. We think that we'll only get 1 to 3 rate cuts in the next 12 months. Given that the cash rate's at a 12-year high, I mean, that's not really too many rate cuts in the big scheme of things. I think monetary policy at over 3.5% is still restrictive for Australia.
Okay, so does that mean kind of normal monetary policy is around 3.5%, which means mortgages are kind of closer to 5 or 6?
Yeah, I think that a more of a that neutral rate that economists talk about is probably somewhere 3 to 3.5%. So yeah, mortgage rates, just like you said, between 4.5% to 5%, I think would be much better for the consumer overall in terms of how much they're spending of their disposable income to household debt.
Diana, thank you for talking to Fear and Greed.
Thanks, Sean.
That was Diana Mousina, Deputy Chief Economist at AMP. This is the Fear and Greed Business Interview. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.